Disclaimer, this video is for educational and informational purposes only. The content shared does not constitute financial, investment, or trading advice. Right now, if you pull up a chart comparing the price of gold to the price of silver, specifically the gold to silver ratio, you'll see a number that has not registered at these levels in years, and the direction it's moving, the speed at which it's moving, and what it historically signals about the precious metals market should get your attention. Not tomorrow, not next week, right now. For those watching silver specifically, this ratio is one of the most important signals you can track. It tells you something that the spot price alone will never tell you. It tells you whether the market sees silver as primarily a monetary asset moving in sympathy with gold, or whether the market is pricing in silver's industrial demand and scarcity value independently. And right now, that ratio is screaming a message that most people in the mainstream financial world are completely missing. Today, we're going to break down exactly what the gold to silver ratio is, why it matters, what history tells us when it reaches extremes, and what the current reading suggests about where both metals, but especially silver, might be headed. This is not speculation. This is not prediction. This is pattern recognition based on decades of market data. Let me start with the basics, because understanding the gold to silver ratio is foundational to understanding precious metals markets as a whole. The ratio is simple in concept, but profound in meaning. You take the current price of gold per troy ounce. You divide it by the current price of silver per troy ounce. The result is a number that tells you how many ounces of silver it would take to buy 1 ounce of gold. For most of the past decade, that ratio has sat somewhere between 65 and 90, meaning it took 65 to 90 ounces of silver to equal the price of 1 ounce of gold. That's the range the market has considered normal for the last 10 years. Not written in stone, not a law of physics, just what traders and investors have been willing to trade at, on average. But ratios don't stay static forever. They oscillate, they compress, they expand. And when they reach extremes, historically, they've been signals. What we're seeing right now is the ratio at historically elevated levels. And the reason that matters is because extreme ratios, in either direction, have preceded some of the most significant precious metals moves in modern history. Let me give you the historical context first, because it's the foundation for understanding what's happening now. In the early 1980s, when Paul Volcker was breaking the back of inflation by raising interest rates into double digits, precious metals were in a bull market. Gold was soaring. Silver was soaring even harder. The gold to silver ratio compressed dramatically. At one point, it fell below 20. That means 20 ounces of silver bought an ounce of gold. The ratio got so compressed that silver was outperforming gold on a percentage basis. People talk about silver being a better percentage play in bull markets. That compression ratio is what they're referencing. It happened. It was real. And it reflected a market where silver was not just following gold. Silver was moving on its own strength, driven by industrial demand and monetary demand firing simultaneously. Then the bull market ended. Interest rates crushed inflation and crushed metals. The ratio expanded again. It expanded a lot. By the early 1990s, it was back in the 50 to 70 range. That expansion reflected a market where gold was holding value better than silver during the downturn, which makes sense because during deflationary or disinflationary periods, the safe haven narrative favors gold over the industrial metal. Fast forward to the 2008 financial crisis. Another compression. The ratio fell into the low 40s. Why? Because during the crisis, yes, both metals sold off initially. But as central banks began printing money and implementing quantitative easing, investors saw a world of coming inflation and debasement. Silver, with its dual nature as both a monetary asset and an industrial asset, started to perform. The ratio compressed because silver was gaining relative to gold. Then 2011 hit. The Fed ended QE2. Interest rates were expected to rise. The precious metals bubble deflated. The ratio expanded back out. By 2015, it was back in the 70 to 80 range. This is the pattern. Ratio compresses during bull markets where both metals are strong. Ratio expands during periods of uncertainty or dollar strength. Now, here's where it gets interesting for right now. Over the past few years, the ratio has been sitting at elevated levels. We're talking 75, 80, sometimes higher. That's the upper end of what's been normal for the past decade. But recently, we've seen the ratio start to compress. Not dramatically, not yet, but directionally it's moving. And the timing of that compression, the speed of it, and what's driving it tell us something significant about the market's view of where precious metals are headed. The reason this matters is that the gold to silver ratio is fundamentally about relative value and relative demand signals. When the ratio is high, it means silver is cheap relative to gold. It means you're getting more silver per unit of gold. When the ratio is low, silver is expensive relative to gold. You're getting less silver per unit of gold. Now, on the surface, you might think a high ratio means silver is a better buy. And sometimes that's true, but it's more nuanced than that. A high ratio can also mean that the market sees gold as the safe haven and silver as the risky asset. It can mean that monetary demand for precious metals is weak, because if people are buying metals primarily for safety, they'll favor gold. Silver will lag, the ratio stays high. But when the ratio starts to compress, when it starts to come down, that's often a signal that something has shifted in how the market views these metals. It usually means one of two things is happening. Either a bull market is forming where investors are comfortable taking risk and allocating to silver as well as gold, or the market is pricing in a scenario where silver's industrial demand or scarcity value is becoming more important relative to gold's safe haven narrative. Right now, I think we're seeing both of those forces at work simultaneously. Let me break down what's actually driving the ratio compression we're seeing. The first factor is the structural supply-demand picture for silver that we've documented extensively. The Silver Institute Institute has confirmed consecutive years of global supply deficits. Industrial demand from solar, from electronics, from 5G, from EVs has been accelerating. Mining supply has been flat. COMEX inventories have been declining. The Shanghai premium has been persistent and substantial. All of these signals point to a market where physical silver is getting tighter. Now, gold has its own supply-demand story, but it's different. Gold is not consumed industrially the way silver is. Gold is mined as a primary product. Gold supply is more stable. When central banks talk about diversifying from dollar reserves, they talk about gold. When investors get scared, they buy gold. Gold has a narrative. Silver's narrative is more complicated because silver has to be valued both as a monetary asset and as an industrial commodity. When the gold to silver ratio compresses, it usually means the market is starting to factor in silver's industrial and scarcity value more heavily. It's saying gold is great as a safe haven, but silver is actually becoming scarcer and more useful. That's the compression signal we're seeing right now. The second factor is the broader precious metals sentiment shift. We've been in an environment where the Federal Reserve kept rates elevated and signaled patience on cutting rates. That environment was more favorable to the dollar and less favorable to precious metals generally. But that environment is starting to shift. Central banks around the world are beginning to cut rates. The Fed itself is signaling potential rate cuts ahead. When rate cuts are in the pipeline, precious metals tend to perform better because the opportunity cost of holding non-yielding assets goes down. And when precious metals perform better, silver tends to outperform gold because of leverage to the bull market thesis. The third factor is what I call the monetary stress signal. We're seeing central banks, particularly outside the US, starting to accumulate gold more aggressively. That's a monetary signal. It's saying, we don't have faith in the dollar-denominated reserve system. When that signal gets loud enough, it tends to pull both gold and silver higher, but it especially pulls silver higher because silver has a historical association with monetary systems and because of the leverage effect of the ratio. Now here's the part that should catch your attention. Historically, when the gold to silver ratio has compressed significantly from an elevated baseline, it's been followed by periods where silver significantly outperforms gold on a percentage basis. The 1980s bull market saw a ratio that compressed from above 80 to below 20. Silver gained roughly 1,600% in nominal terms from the 1970s to 1980. Gold gained roughly 1,300%. That's a spread of hundreds of percentage points. The difference was the ratio compression. The 2008 crisis and recovery saw a ratio that compressed from the 60s down into the 40s. Silver gained roughly 500% from its 2008 low to its 2011 peak. Gold gained roughly 170% in the same period. Again, the leverage was significant. We're not saying the ratio will compress to 20 or even to 40. We're not making a prediction about price targets. But history shows that when the ratio moves from extreme highs toward lower levels, silver tends to do the heavy lifting. The ratio compression itself is often the engine of outperformance. Now, let me address what would cause a significant ratio compression from here. The most bullish scenario is an inflationary environment where both monetary and industrial demand for precious metals accelerate. In that world, gold rises because it's a hedge against monetary debasement. But silver rises harder because it's a hedge against debasement, plus it's benefiting from industrial demand. The ratio compresses. This was the 1970s to 1980 story. It could happen again. The second scenario is a credit crisis or deflationary shock where investors flee to safety, but also where industrial demand gets hit. In that world, gold might actually outperform silver initially because it's the ultimate safe haven. The ratio might expand short term. But if central banks respond with massive monetary stimulus, as they always do, the ratio would eventually compress as debasement fears take hold. This was the 2008 playbook. The third scenario, and this is the one I think is most relevant to what we're seeing now, is a situation where industrial demand for silver remains strong while monetary demand for both metals accelerates. Solar keeps growing, EVs keep growing, 5G keeps rolling out. At the same time, central banks diversify away from dollars. Both forces are at work. Silver benefits from both. Gold benefits from the monetary side. Silver pulls harder. The ratio compresses. In that scenario, we could see the ratio fall from current levels in the 75 to 80 range down toward 50 or even lower over the next few years. That would not require silver to reach some absurd price target. It would just require silver to outperform gold. And history says when the ratio is at elevated levels and starts compressing, outperformance is exactly what happens. Now, what should you be watching to track this in real time? First, the ratio itself. This is free data. You can pull it from any precious metals data provider, Goldfix, Reuters, Bloomberg, your brokerage platform. Plot it over time. You're looking for a sustained compression trend, not just a day or two of movement. The trend matters more than the daily number. Second, track gold and silver separately. You need to see which metal is doing the heavy lifting. Are they both rising and silver is just rising faster? Or is silver rising while gold stagnates? The answer tells you what's driving the compression. Third, watch the drivers we've discussed. Monitor COMEX registered silver inventory. Watch Shanghai premiums. Track industrial demand data from the Solar Energy Industries Association, from copper mining reports, from electronics manufacturing data. If industrial demand is accelerating while supply is flat, that's ratio compression fuel. Fourth, pay attention to central bank accumulation data. If central banks are diversifying into precious metals, both metals should rise, but silver should gain relative to gold. Fifth, track rate expectations. When rate cut probabilities increase, both metals tend to perform better. Silver usually outperforms. Finally, watch the gold to silver ratio itself in context of historical readings. If you're looking at a 20-year chart, you can see where the ratio sits relative to historical extremes. Right now, we're in the upper range of the past decade, but we're not at decade extremes. There's room for compression. Here's what I want to emphasize about the current moment. The gold to silver ratio at elevated levels is not a warning sign. It's not a signal that you should avoid silver. It's actually the opposite. Elevated ratios have historically been the setup for ratio compression, which is the engine of silver outperformance. We're not saying it will happen tomorrow. We're not timing it to the day. But historically, when you see an elevated ratio and you see the fundamental conditions for compression forming, that's the signal that's worth paying attention to. The structural supply deficit for silver is real. The industrial demand is real. The COMEX inventory decline is real. The Shanghai premium is real. All of these point to silver becoming relatively scarcer and more valuable. When the market prices in that scarcity, it does so through ratio compression. We're seeing the early signs of that now. For investors who have been holding silver, the ratio compression signal suggests patience is warranted. You don't need the price to do anything special tomorrow. You just need silver to do what it's historically done when the ratio is elevated. Outperform. For investors who have been on the sidelines, the ratio compression is a signal that the setup is forming, not a guarantee. Never a guarantee, but a signal. The gold to silver ratio is not a crystal ball, but it is a record. It's a record of what the market has done when conditions looked like they look now, and that record is worth studying. Thanks for watching. If you found this useful, hit the subscribe button. I track the ratio weekly, and I'll report back when it reaches critical levels or when the trend changes. Until then, stay informed and stay sharp.